Absolutely. Here's a refined rewrite of your script as a single, continuous narrative with a clean, compelling flow. Cargo ships are stalled. Ports from Shanghai to California are backed up. Amazon is canceling orders mid-transit. And China isn't making announcements, it's making moves. What's happening isn't a simple trade dispute. It's a calculated, high-precision disruption of America's supply chains. The ripple effects are showing up where they hurt most. In higher prices at the checkout line, in delayed car payments, and across the backbone of U.S. industry. On April 3, 2025, the Chinese government quietly issued a directive to its state-linked airlines. Suspend all new Boeing aircraft deliveries. No public statement, no fanfare, just a freeze that erased $28.4 billion from Boeing's market value in 2 days. The move affected 84 aircraft set for delivery in the second and third quarters, including the vital 737 and 787 Dreamliner models. Boeing had publicly pinned its hopes on these sales to recover from post-COVID delays. But this wasn't about aircraft performance. A leaked memo from China's Ministry of Commerce, obtained by the South China Morning Post, revealed the real motive: retaliation. The directive was a targeted counterstrike against escalating U.S. tariffs. Boeing, a symbol of American industrial power, was the first to fall. As Scott Kennedy of CSIS said, this wasn't a trade rebuttal. It was a surgical pressure campaign. While Boeing floundered, Airbus saw its stock surge over 11% as Chinese buyers redirected their orders. Beijing's message was subtle but unmistakable. Escalate further, and we'll find your pressure points. And press. But the real blow didn't come from the skies. It came through the water. On April 1st, the Trump administration imposed a 145% tariff on over $300 billion worth of Chinese imports. A move the Wall Street Journal compared to turning a scalpel into a wrecking ball. Within days, Chinese exports to the U.S. dropped by nearly half. Over 71,000 containers sat immobilized at major ports in Shanghai, Ningbo, and Shenzhen, some stranded for more than 10 days. The U.S. West Coast soon felt the shock. At the port of Los Angeles, congestion climbed to levels not seen since the 2021 pandemic surge. Ships waited offshore for days, unloading delays hit 96 hours. And the cost of shipping a 40-foot container from China to Long Beach exploded, jumping from $1,150 to $6,820 in just 10 days, a 250% increase tracked by the Freightos Baltic Index. This wasn't just a slowdown, it was a breakdown. Chinese shippers began walking away from negotiations mid-process, citing unstable tariff rules. "You can't price a shipment when the rules are changing mid-ocean," said Jiang Qing of Sotrans Logistics. What started as pressure on China ended up choking American supply lines. Once cargo stops moving, the fallout is immediate and far-reaching. By April 6th, China's top 5 freight forwarders, including ZTO and Costco Shipping, suspended most U.S.-bound bookings, citing the financial risks of retroactive tariffs. Behind the scenes, exporters were cornered. Ship into chaos or take unrecoverable losses. In Dongguan, the electronics manufacturing hub that powers nearly 8% of China's global electronics exports, over 1,200 factories went dark. "Our goods are packed, labeled, and sitting at the port," one supplier told Kashin Global. "The freight company canceled. We don't even know if they'll move this month." This isn't theoretical. It's measurable. U.S. Customs data from early April showed a 34% drop in shipments from China compared to March. For now, store shelves may appear normal, but the disruption has already begun moving through the system. And it's not just small products going missing. It's major retail operations feeling the squeeze. On April 7th, Amazon told its U.S. sellers to pause incoming shipments from China, while it reassessed tariffs and warehouse availability. Just 36 hours later, Five Below confirmed the cancellation of over $67 million in inventory. Goods already in transit. That was 11% of its second quarter supply. CEO Joel Anderson said during their April 9th earnings call, "We couldn't justify paying triple the landed cost on items already struggling with margins." These aren't minor tweaks. They're emergency decisions made by companies whose business models depend on high volume and razor-thin margins. Canceling in transit isn't just expensive, it's a sign of panic. Selling overpriced goods to cost-conscious customers risks more than losses. It risks loyalty. And the blow came as consumer sentiment dropped to 75.1, the lowest since mid-2022, according to the University of Michigan. With back-to-school inventory in limbo and summer goods stuck in port, retailers are turning to domestic alternatives. But for how long can they hold? This goes beyond retail now. It's tearing into American manufacturing. On April 11th, Ford's Wayne, Michigan plant shut down production of the F-150 Lightning due to missing microcontrollers from Shenzhen. GM's Tennessee battery plant cut output by 60% after key components failed to arrive. AutoCast Solutions reported that 41,000 vehicles were lost in 1 week of U.S. production, a $1.6 billion revenue hit. Stellantis warned that disruptions would affect production through June. The auto industry doesn't run on flexibility. It runs on precision timing. You can't build a modern car without a $12 chip, said Kristen Zichek from the Center for Automotive Research. Despite diversification efforts, the average American-made vehicle still depends on more than 24 components sourced from China. Now, with delays piling up, some plants are cannibalizing unsold vehicles for parts, something not seen since early COVID days. But this isn't COVID. This is geopolitical pressure. And if the White House can't stabilize trade routes fast, the next auto shortage might not be temporary. It could be structural. Between April 1st and April 14th, the cost of shipping a container from China to the U.S. soared from $2,000 to over $7,300, according to the Freightos Baltic Index. That spike is echoing through every corner of U.S. industry, especially in sectors like electric vehicles, where companies like Stellantis still import nearly a quarter of their key components from Chinese ports. This isn't just economic friction. It's a slow-burn standoff with billion-dollar consequences. In just 1 week, average dealer prices for plug-in hybrids jumped between 6.8% and 8%, driven not by demand, but by transportation volatility that manufacturers say is now unrecoverable. Ford's Mustang Mach-E alone saw a $2,200 increase in MSRP after freight contracts were renegotiated mid-transit. And it's not just new vehicles feeling the squeeze. Used car prices are climbing too. According to Cox Automotive, wholesale values rose 4.1% in mid-April, the sharpest spike since the 2021 chip shortage. This isn't random inflation, it's logistics weaponized. Every delay, every shortage, every cost increase is the fallout of rerouted cargo and shifting trade policies. U.S. dealerships are already responding by cutting inventory by as much as 30% to avoid taking on bloated costs, according to a CNBC dealer survey from April 17th. If you thought prices peaked during the pandemic, think again. This isn't just a supply chain issue. It's what happens when that chain gets intentionally tangled. So the bigger question becomes, are these price hikes temporary, or is this just the new normal in a fractured global trade landscape? On paper, moving production away from China sounds like a solution. In practice, it's proving chaotic. Vietnam's ports, like Hiep Phuoc and Cat Lai, were running at 94% capacity by mid-April, causing shipment delays of up to 6 days. In India, over 60% of domestic freight still travels by road, slowing delivery times dramatically compared to China's rail network. In Mexico, companies are battling border delays. Commercial vehicle wait times at Laredo spiked from 4.2 to 12.5 hours in April alone. Tesla, after shifting battery module production to Nuevo León in 2024, is already renting emergency warehouse space in Arizona due to congestion. Apple's move to Tamil Nadu hasn't gone smoothly either. Defect rates from its new suppliers are reportedly 14% higher than those in Shenzhen. Yes, the manufacturing base is shifting, but the transition isn't seamless. These new supply partners aren't slotting in neatly. They're revealing a new web of inefficiencies and vulnerabilities. This may not be a clean substitution. It might be full-on fragmentation. On April 12th, China restricted exports of dysprosium and terbium, two rare earth metals critical to electric vehicle motors and aerospace tech. Just 11 days earlier, the U.S. had announced a 145% tariff on Chinese EVs. The message was clear. According to Adamas Intelligence, 78% of America's rare earth imports come from China, and the response was immediate. Lockheed Martin warned lead times on missile guidance systems could stretch from 14 to 22 weeks. Ford paused production on its E-Transit van and F-150 Lightning due to magnet shortages. Raytheon began lobbying the Pentagon for fast-tracked permits to mine in Canada and Australia. But even the best-case scenarios don't put new sources online until late 2026. Beijing didn't shut everything down, just enough to remind Washington who holds the cards. In a rare admission, GM's executive vice president Doug Parks told Bloomberg, "There's no substitute fast enough or cheap enough to replace what we're now cut off from." This wasn't a random embargo. It was a precision strike, targeted at industries too strategic to lose and too slow to pivot. Auto manufacturing isn't bouncing back, it's rerouting. Tesla plans to move Model 3 assembly to Berlin by Q3, cutting US-bound components from the process entirely. Toyota is redesigning its 2026 hybrid models to cut chip dependency by 30%. And Stellantis is temporarily relocating production of several US-bound models to Mexico. These shifts aren't cheap. New platforms, supply contracts, and labor deals are adding 4 to 6 months to production timelines. For consumers, that means longer waits, higher prices, and fewer features. J.D. Power's April report shows the average new car in the U.S. now costs $47,770, up $2,600 in just a month. But for many automakers, there's no other option. China is no longer dependable, and alternatives can't scale quickly enough. This isn't just a shift, it's the disintegration of a global system that once seemed untouchable. And yet, the most critical changes aren't happening on production lines. They're happening in the background, on spreadsheets and in boardrooms, where the collapse of trust in globalization is taking shape. Foreign holdings of U.S. treasuries have dropped to their lowest level since 2011. China isn't just pulling back on goods, it's quietly shedding American debt. If that trend continues, if Beijing starts targeting the dollar itself, the next rupture won't hit car lots or cargo ports. It'll hit the global financial system. That's the next fault line, and we're heading straight for it.